So you're ready to start investing. You open up your brokerage account, you're excited, and then, bam, it hits you. You're staring at a wall of thousands of company names, ticker symbols, and it all boils down to one massive question.
I mean, seriously, where do you even begin? It can feel completely overwhelming, like trying to find a needle in a haystack. If you've ever felt that, you're not alone. It's called analysis paralysis, and it's totally normal. But here's the good news. Investing doesn't have to be a guessing game. There's a much, much smarter way to go about it.
And the solution isn't some secret hot stock tip from a Wall Street guru. Nope. It's about building a simple but really powerful framework for yourself. A system that helps you cut through all that noise and gives you the confidence to make smart, informed decisions. So here's our game plan. We're going to break it all down into 3 core pillars. First, how to find a genuinely good company. Second, how to figure out the right time to invest. And third, this one's key, how to know if it's the right fit for you. Then we'll pull it all together so you can walk away feeling like a true investor. All right, let's jump right in with pillar number 1, finding a good company. This is all about putting on our detective hat and using something called fundamental analysis to really look under the hood of a business. So what on earth is fundamental analysis? Well, the idea is actually pretty simple. You're not just buying a little ticker symbol that bounces up and down on a screen. You're buying a piece of an actual real-world business. And the goal is to understand that business so well that you'd be happy to own it, even if the stock market shut down for a whole year. And a huge part of this is identifying what's called a company's competitive moat. Just think of a castle with a big moat around it. It's there for protection. For a business, this moat is some kind of durable advantage that protects it from the competition. It could be a super strong brand, unique technology, anything that keeps customers coming back and competitors at bay. So how do you know if a moat is healthy? Well, you can look for some signs. A really good sign is when a company is actively making its moat wider, maybe strengthening its brand or investing in new tech. A risky sign is when the moat is just there. It's not growing and new competitors are starting to pop up. But the big red flag, the alarm bell, is when that moat is actually shrinking. Maybe new technology has just made their old advantage totally irrelevant.
But listen, a great story about a company and its moat isn't enough. You have to check the numbers. Think of a company's financial statements as its report card. It's the hard evidence that proves whether the story is actually true.
Now, let's look at 2 key grades on this report card. First up is return on equity, or ROE. This basically tells you how good the company is at making money from the cash investors have given it. You want to see a consistently high number here. But, and this is super important, you also want to see a low debt-to-equity ratio. A super profitable company that's drowning in debt is still a huge risk. High profitability with low debt, that's the sweet spot. That's the gold standard. Okay, you found a great company with a strong report card. Fantastic. But is now the right time to buy it? This brings us to pillar 2, where we use something called technical analysis to get a read on market psychology.
Now, let's be really clear. Technical analysis is not a crystal ball that predicts the future. What it really is a tool to read the mood of the market. See, a stock chart is just a visual story of the constant battle between buyers, who are often driven by greed, and sellers, who are often driven by fear. Let me show you a classic example. This uses moving averages, which just smooth out a stock's price over time. A golden cross is when the short-term price trend crosses above the long-term trend. It's seen as a bullish signal, a sign that positive momentum is building. On the flip side, you have the death cross. Sounds dramatic, right? That's when the short-term trend dips below the long-term one, acting as a bearish warning sign that the sellers might be taking control. And that brings us to pillar number 3, and honestly, this might be the most important one of all, the right fit. Because here's the thing, you can find the best company in the world and buy it at the perfect time, but it can still be a terrible investment if it doesn't fit you. So you have to do an analysis of yourself. You need to ask 2 really simple questions. 1, what am I investing this money for? And 2, when am I going to need it back? Think about it. Someone saving for a down payment on a house in 2 years should be investing very, very differently than someone saving for retirement in 30 years. Your timeline is everything. And a huge part of finding the right fit is proper diversification. And believe me, this is where a ton of beginners make a mistake. Owning 5 different tech stocks is not diversification. That's concentration. Because when the tech sector gets hit, all your stocks go down together. True diversification means owning businesses in different areas of the economy, tech, healthcare, industrial companies that don't all move in lockstep. Okay, So let's put it all together. How do we take these 3 different ideas and combine them to become a true investor? The real magic happens when you integrate these pillars into one cohesive strategy.
It's this simple hybrid approach. Step 1, you use Pillar 1, fundamental analysis, to figure out what to buy, to find that great company. Step 2, you use Pillar 2, technical analysis, to help you decide when to buy, to get a sense of the market's mood. And finally, Step 3, you use Pillar 3 to make absolutely sure that this investment is the right fit for you and your plan.
And that right there, that's the ultimate goal. This whole framework is designed to help you shift your mindset from being a short-term speculator, which is basically just gambling, to becoming a true, thoughtful investor who's building a portfolio for long-term success.
So now you have it, a powerful 3-pillar framework to help you cut through all the confusion and get started with real confidence. The only question left is, what company are you going to put under the microscope first?